Well, after an extended break, and Blake and I have missed you all very, very much indeed, we're back at it with the 2025 trade-off going forward. Now, of course, we've got the Fed meeting. We've just seen that coming out. We just dissect exactly what's going on and what potentially could propel them. They're in a wait-and-see mode, which could really see volatility in the rates market suppressed for a period of time. And when we're talking about volatility, of course, we're looking very closely at what's happening in FX, because we are expecting an announcement over the weekend on tariffs, and tariffs are going to be the refocus of the market. Again, talking about volatility, it's hard to get past what we're seeing in the AI space and Nvidia, and we're seeing some big volatility playing through. Everyone's obviously very much familiar with the word DeepSeek at the moment. We do have mega cap earnings coming through, and again, that's key, causing some volatility at a single stock level. We have a look at charts that we like in terms of the Germany 30, the DAX, and we're looking at the dollar, and also plays coming through as well. There's a lot going on in financial markets. We break it all down in today's trade-off. Well, hello, I am Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by my good friend and comrade, Blake Morrow from Forex Analytics, and we'll be breaking down all the charts that matter, the flows, the news, and there's a lot of it coming through in markets at the moment. How we can look for signal in the noise and the price action that matters and is front of mind on our radars at the moment. So, Blake Morrow, coming to the programme. Mate, for the last 10 days or so, I've been sitting by a pool in the outback of Australia, tending to my cattle and my flock, and absorbing the 44-degree heat and the snakes as well that's coming through. Now, I've missed a bit. I'm back at it. I'm connected, refreshed and connected back into markets. But how have you been, my good friend?
I've been great. Happy New Year. Happy holidays. I know it's we're a month past all that, but It's been that long since we've seen you all. So, and great to see you, Chris. I knew you really had an affinity for our new U.S. president, or Donald Trump, once again, 2.0, even to replicate his tan. Very, very well done. Very well done.
I'll take it, to be honest. It won't take long before it fades as the Melbourne summer dissipates. But it was nice to get back out there and take yourself away from financial markets completely. I think it's nice for the soul. It's good for the brain mindset, and it gives you that clarity as you come back into markets and look to approach what is clearly a very volatile situation playing through.
Well, Chris, I'm going to say you missed nothing. It was so boring while you were gone.
Yeah, right.
There wasn't anything going on.
Yeah. Yeah, I think. Well, let's break it all down, because what's happened in the past does set a platform, but we're looking forward now and looking to manage the risks and see what potentially could make up in terms of the probabilities. Let's go into topical thunder. Let's have equity moves. I know the Fed meeting's just been out, but I think really, equities are really, really important. They're getting such a good flow at the moment. I think over the weekend, everyone became a bit more familiar with LLMs and large language models and DeepSeek and innovation that's coming through, and the idea that, we could see US exceptionalism under threat over time. People obviously looking at the idea about the CapEx cycle, certainly in the AI CapEx cycle from the hyperscalers, not for this year, as we've just seen from Meta's earnings. They're obviously committing to that 65 billion investment going forward, and obviously names like Google and places are still making that investment as well. But there are obviously interesting situations about the conjecture about the 2026 CapEx cycle and how that feeds into Nvidia and plays like that as well. But certainly if you look at Nvidia, we've seen some we saw a staggering volatility on the Monday trading session. Huge liquidation of long positions playing through. All the banks were reporting that they were better to sell across all different parts of their client base. After market today, we just see Meta coming out. That stock looks absolutely breathtaking at the moment. We see big moves up in IBM. The realised volatility in these single stock tech and AI names and hardware names, and is obviously pretty high at the moment. The Nasdaq's trading in a bit of a range at the moment. I fancy it a little bit higher in the short term. But how are you seeing the index and single stock names at the moment?
Well, first of all, the whether you believe the hype of DeepSeek or not, the bottom line is everybody's models, whatever they were looking at last week, probably look a little bit different from an investment landscape today. The good news is, as far as the indices go and what the NASDAQ's doing, I mean, look at Amazon. It's at all-time highs right now. And it bounced back. After it was at all-time highs. Monday, it sank. It came back to all-time highs yesterday, and it's holding up. You're seeing a lot of money. It's like rotation inside the Mag 7. You know, you lose a little bit at Nvidia, and yeah, you got your Metas and, you know, even Apple picking up some of the slack. So structurally, the markets still look pretty darn good. We still have earnings for Apple tomorrow, and we have Amazon next week. It got shifted from this week to next week for whatever reason. And overall, I think the markets actually look not bad. And I know you're going to take a look at some of the European bourses too a little later. They look great. I mean, the markets look structurally okay. Now, are we a little bit worried about what's to happen this weekend? Well, we're going to talk about that because I think this weekend there's a lot of risk, and I think there's some gapping risk for Monday. So,
yeah, you make a good point, Blake. What do we do as traders? We manage risk, and we obviously try and get correct position sizing. But we're risk managers at the end of the day, and yeah, I think that's a really important point. Yeah, it'd be interesting to see, the dollar pairs, the CAD, the MEX. Obviously the Chinese yuan, the CNH, as we go into the weekend. Do we see some position squaring coming back into the weekend on that as people look to sort of manage that risk on a potential tariff announcement? Back to you. Let's tease you up nicely.
And speaking of this weekend,
we're professionals at this now.
Thank you. Yeah, we're really good. Speaking of this weekend, let's talk a little bit about tariffs. And it's funny, Chris. Tariffs haven't affected the markets at all. And I know you were out last weekend and you were disengaging from the markets, which is great because every Asian morning for you guys, the Asian session mornings were very active because at night here, Donald Trump would be talking. He would be talking about tariffs. The dollar would rip. We'd see a 50, 70, 80 pip drop in the Aussie. It would bounce back, going into the European session and US session. We saw so much volatility. The fact of the matter is, if you look at equities, they've been brushing this off. And it's interesting because so many people say his bark is way worse than his bite. And I think the equity markets simply are just proving that. Now, FX markets are obviously a little bit more sensitive, and I think everybody's a little bit more on guard. But it also speaks to the idea that I think the risks are underpriced for what's going to happen this weekend. Now, I've read a lot of analysis just going back to, the previous administration, and they gave the 2-week warning a lot. Like, hey, in 2 weeks, we're going to do this. In 2 weeks, we're going to do that. February 1st, we're going to do this. And a lot of those dates would come and go and pass and nothing would happen. Doesn't mean that we won't eventually get some tariff announcements, but are we going to get them this weekend? And fact of the matter is, what kind of tariffs? Because the market has an idea of what they think. Donald Trump, even just a couple of days ago, said, Scott Bessent, as he was getting confirmed by Congress, he was saying 2.5%. That's where he thinks that tariffs should be. Trump literally was tweeting and talking just over him, not at him, just on the side, that 2.5% is just not enough. And so there's probably a lot of talk about what's going to happen this weekend. But if tariffs don't happen this weekend, they're happening. Don't worry about it. They're coming, right? So,
but I think
anyway, let's talk about
the Bessent 2.5% universal tariffs is, that's the starting point. But as Trump wants them higher, they may go up over time. So maybe we get the 2.5% universal tariff starting point. But I think the interesting thing is, obviously, you saw that with the Colombians earlier in the week. Trump wanted migrants being brought back to Colombia. The Colombians initially said that wasn't going to happen. He threatened an extra 25 percentage points in tariffs. The Colombians backed down, rolled out the red carpet to the immigrants, brought them back in, and Trump put the tariffs on hold. So he can see this, especially in those the smaller economies. He knows that he can weaponize tariffs in a big way. I think this week, the base case of the market, Blake, and it'll be interesting. I know we've got to move on, but The base case of the market is we're really looking at Mexico, Canada, and China over the weekend. Will we see 25% tariffs on Mexico and CAD? I think is the initial one. I suspect the market is thinking that we'll get a pushback, that we won't see them implemented this weekend, and they will say we're making some progress and we're going to revisit these again at another time. But I think the real risk for anyone who's got CAD or MEX positions is that we do see those tariffs being put in at 25%. That would cause the CAD to weaken off significantly, in my opinion. Obviously, there could be some carve-outs. Things like oil imports and stuff could be carved out. So it's not just a question of, do we see 25% tariffs? There could be some major things that could be taken out of that tariff basket. But obviously, it does seem a bit binary. You could see some relief and CAD buying if we do see that 25% tariff being pushed out, which I suspect is the case. But obviously the risk is we do see those 25% tariffs being put in. And then the question for you, Blake, and for the market, of course, is if we were to see them being put in, do the Canadians then respond back? And we know they will. And that's where we do see the big volatility in FX markets. And so I think it's an interesting spot. And FX is the place to watch. That's where we're going to see the volatility playing through. So if you're an FX trader, tariffs is the name of the game. There we go.
FX is back, baby.
It's back, baby.
FX is back.
And hopefully a bit of vol hurt no one. Anyway, I want to talk about the Fed meeting because I don't think we learned a huge amount, to be honest. It was a bit of the market reaction. Yeah, it's a bit of a yawn fest, but I think that's fair. I think it's a fair reaction because the Fed are in a good spot. They are in a good spot and they're on hold for a period of time. Jerome Powell talked about that. So I don't think we need to dissect it into sort of granularity that a lot of macro guys are doing, because I think that the simple solution is that the Fed are waiting on data and the market will as well. There's 4 basis points of cuts being priced into the March meeting now, and I think that's a fair call. I think people are pretty neutral on duration as a result of what we've been seeing. So it's wait and see. What are we watching for? We've got a payrolls number coming through on the 7th, and we've got the next CPI number coming through on the 12th, and the Fed's reaction function is more skewed to the inflation dynamic as part of its dual mandate than labour markets. But I think over time, Blake, the risk for me now is that we start seeing weaker payrolls number. With immigration, 2/3 of labour of jobs have been filled through government workers over 2024. With Doge coming through under Musk, those workers will not be as prevalent this year. So the payrolls number, for me, the risks are that we see that cooling down significantly over this year. Inflation, for me, continues to fall just because of base effects. So for me, I think the market's underpricing cuts for this year. We're only pricing 2 cuts. But I think, short-term NFP on the 7th, CPI on the 12th, I think could be really interesting. But we're in a wait-and-see mode, and I think that's going to suppress rates volatility, and that may have some dampening effect on FX vols as well. How are you seeing this?
Well, I agree with you. And I think, and I know a lot of people will disagree with us both saying that, we see further rate cuts. But if you listen to Waller, who is in line, to take over for Powell, not until 2026, but still his voice is going to carry some weight here.
Yeah, for sure.
He's still looking for cuts, and he believes that the market should have some rate cuts coming this year. And I think you're exactly right. Looking at the labor data is going to be really important. You're right because of drop off effects of CPI. We will see CPI continue to move lower, but does it remain sticky? And there's a lot of debate whether tariffs will be inflationary or deflationary. There's a lot. There's even Lutnick, who's going to be the new Commerce Secretary. He was even on Capitol Hill today saying how tariffs are not inflationary. They're not.
Well, they're one off. But the thing for me, if you're looking at core PCE, which of course is what the Fed look at, it's really about the owner's equivalent rent, which is a nonsense number. No one ever pays it, but it is big part of the basket. The base effects will kick in, and just purely from that, the housing numbers, the rents will fall over the coming 2 quarters, and I think just from that effect, it should weigh on the year-on-year pace. And it's Powell made it very clear that he is looking at the 12-month rate at the moment. So I think just base effects and what's happening in housing and own equivalent rents, I think is going to drag down inflation from that situation. But I do think the Fed have made it pretty clear now. They've got a dual mandate, maximum employment, price stability, at this point, their reaction function is much more skewed towards price stability and the inflation data than the labour market, which they coin as solid.
Yeah. Okay. Well, that's and it's going to be an interesting. Let's just say, and I think we could both agree it's going to be an interesting year this year. The last topic I wanted to bring up was actually, obviously close to your home, is the RBA, and we just saw obviously inflation come in below forecasts yesterday, and the Aussie came under a little bit of fire. But here, I guess the since everybody's anxiously, and I'm sure you guys are anxiously waiting for the RBA to cut and give some businesses, maybe consumers, some relief over there. The fact is, and what I've been looking at is just, and I know we're not going to put up a chart right now, but the Aussie dollar has fell quite rapidly over the last several months. The bounces have been very shallow, and I'm clearly focused on the 60 cent, 61 cent level. We can barely get our head off the floor right now. And the question I really wanted to ask you, your opinion, is, has this already been priced in, already with the RBA? Everybody was expecting inflation to come in a little light, give us the green light for cuts. But how's it going to affect the Aussie dollar? Because if the euro should see, let's just say the euro sees parity at some point through 2025, where's that going to put the Aussie dollar? Does the Aussie dollar trade below 60 cents towards 57 cents? Because there's a lot of air underneath there, technically speaking. And but how do you feel about the RBA and where the Aussie's at right now?
Well, I'm not massively infused by US dollar upside here, to be honest. I mean, it's rich, it's well owned. So I whilst there's still attractions for the US dollar, I think, and you'd be surprised, but having a bull trend, a resumption of the bull trend, I think seems like a fairly low prospect at this stage. But obviously, if we see it, then I'll change my view and react to the price. But I think, obviously a February cut is fully priced. I mean, the market is saying it's a done deal now. That trim mean number that we saw on a quarter-to-quarter basis was enough to justify that. Again, the RBA have got a dual mandate like the Federal Reserve, full employment and price stability. And their reaction function is more skewed towards price stability. And that inflation dynamic, which they're seeing now, is giving them enough confidence to cut, will be the case. But I think what's important to drive the Aussie, other than the fact that it is a vehicle for China, for market sentiment, macro forces, if you're looking at it from a pure rates perspective, look, February's fully cut, price for that cut. Where it comes interesting and where we could see is the terminal pricing. The market is kind of torn behind the idea, do we see 2 rate cuts this year? Do we see 3? 3 or 4 rate cuts this year? And I think that's obviously signalled that when the RBA do start cutting, that it's going to be a fairly shallow cutting cycle. And what we can see from the data really justifies that. There's really no need to stoke up demand or animal spirits. What we're going to see from a cutting cycle from the RBA is going to be purely a risk management exercise at this stage. But again, the data will drive. If we were to see, the unemployment rate start to pick up, it's a very strong labour market at the moment. If we were to see a change of government and a minority government coming through in May, and that leads to lower fiscal spending, which has been such a supportive measure, the market might start to say that the terminal price is too low and could come lower. That's where we'd probably expect to see the Aussie under sizable pressure, but that's not going to happen anytime soon. As a moment, I think once we sort of get over this RBA situation, look, we've got an RBA assistant governor speaking very shortly, actually. But once we get past this rate cut situation, again, it just comes back to using the Aussie dollar more as a market sentiment vehicle. What are equities doing? What's commodity prices doing, and what's the feeling towards China as well? So, a rate cut in February is done. What we're sort of debating now is how far they could be cutting in this cycle. I think is probably the bigger driver now. Anyway,
great summation. Thank you, Chris.
Bring on the cuts. Bring on the cuts. Bring on the cuts. For people who are massively over leveraged in their housing budgets and bought way too much, bought an asset that's way too expensive for their earnings, we're feeling a little bit better than them. Anyway, let's go into the charts that matter. Right, I want to go to the DAX, or the Germany 40 as it's commonly known on the retail trading platforms. What do we like, Blake? We like things that are strong. We're attracted to things that are moving. It's doing that for a reason. The market likes the story. remember, when we're trading, it's not really about what I think, it's about what we think the market collective thought wisdom is doing, and the shared beliefs and the aggregation of all flows. And right now, whether you're looking at it in the euro terms, which of course the DAX is priced in, or whether you actually try and price global equity bourses in a single currency like the US dollar to actually compare apples and apples and actually look at it without the currency effect. The DAX is the best performing market of the major markets that we look at right now, and it's bull trending. You can see that throughout January it's had an absolute, sorry to sound like an Australian, it's had an absolute ripper of a year so far. As I say, it's best performing market. It's about over 8% for January. I think it's one of the best performing Januaries that we've seen over the last decade, or probably fifth or best performing January. So this is the strongest market, and it's bull trending. It's above that 5-day exponential moving average, which is really, really strong at the moment. Yeah, look, market breadth and participation is really good. I know there's only 40 stocks within the index, but if you're looking for things that are strong, I mean, it's hard to buy at these levels, but it's breaking out, it's trending. If you're long, or if I'm long, I'm staying long. Look for a close below that 5-day as a sort of an exit signal. Look to trim positions. But right now, if you want to know what's moving in global equity indices, this is the play.
My gosh, it is so strong, Chris. What you don't have is you don't have the RSI on there, and I know. It's something that I kind of rely on.
You don't even need it. I could tell you where the RSI is. It'd be something. If you could tell me, let me have a guess. I guarantee. I promise I've never looked at this. I would say that RSI is at 75, 73.
It might actually be below that. It's divergent. And I don't have it on my screen. Now I have to go find it. Now you're going to make me find it. It is at. Oh, actually, you know what? I take that back, Chris. We are at 80 on the daily.
Oh, sorry, underpricing that. There you go. So the risk is that we may see some consolidation, but the RSI is just really thematic of a market that's very, very strong.
Right, and it is just blown up. Anyway, hey, I'm going to give you something that's not blown up yet, and it's going to be the Euro Swiss. This is why we call it a setup, Chris, and this is bypassing all of the shenanigans that have to do with the dollar. If you want to, I'm going to be focusing a lot on cross rates until I have better clarity on what's going to be happening with tariffs. But right now, I can clearly see that the Euro Swiss is very well supported in this channel. And what you also notice is there's a double bottom. There's also a double top. That means there's a range extension coming on a breakout. So a break above the 200 DMA, the thing gets really bullish. And I'm going to actually be looking for long somewhere near the 94-cent level to see if we can stay inside that channel, because we have the ECB tomorrow. So if we can get a dip down there, I'm going to be a happy buyer, and because I know my risk. And the flip side is if you break through 94 cents, you break through that 38% retracement, you're going to be heading back down towards 92 cents in this big old fat range. And the great thing is when we look at things technically, Chris, and we can actually see where the break points are, we can see where the ranges are at, we can play off of those key levels. And if I can bypass the craziness of the Trump administration and what he wants to do, this allows me to do that, this type of vehicle. So this cross rate, I think, is a great setup for, either a short back into the range or a breakout of that range.
Yeah, good stuff. Okay, I'm going to bring up, the most influential stock, obviously Nvidia. We've been trading in a really nice range for last few months. And we broke out below that bottom end of the range through this week. But the buy the dip crowd have come back, perhaps not as emphatically as some people would have liked. The question is do we go back after that break? Do we actually go back into the range, 128, 150? Obviously I don't know the answers to that. If I did, then I would have been trading it. But that's the question that we're looking at. Are we going to go back inside that range? I don't think we're going to see a breakout of that range anytime soon. But one thing that we will be looking at, obviously, as we talk about in the show, is that we do get earnings coming from the 26th of February. And the market on that earnings day is expecting about a 9% move up or down on the day of earnings. So volatility yet once assured. But, this is a trader's stock right now. And for people who like going two-way up and down. And right now, if you have a look at the 1 month put volatility, implied volatility, is trading at 74%. So people are still big buyers of downside puts, and that demand is seeing that implied vol really come up. So, if you are trading Nvidia, expect movement, expect intraday ranges. Obviously, that plays firmly into your position sizing. You've got to keep it low. You've got to trade with a wider stop loss if you're trading that short term. But the question I've got now is will we roll over and kick back lower as we go in towards those earnings? And obviously, the DeepSeek news and people's perception of the AI cycle will obviously perpetuate. Or do we go back into the range? I suspect we do go back into the range, and we can trade two-way within that. But that's the thing I'm looking at. Do we go back in the range? But obviously, 26th of February is the date for your diary. The market is expecting massive movement on the 26th on the day of earnings. Revenues around sort of $38.2 billion. Nice push up from the last quarter of 35. Gross margins expected around sort of 73-74%. Again, but what happens as we go into earnings for Nvidia is not just around where those central expectations is, but where the buy side are positioned. That's going to be way more important. We don't know that right now, but the price action will tell us everything we need to know. And that's why Nvidia, for me, remains such an important stock for global risk sentiment.
Is it deep seek or deep fake? Yeah, I don't know, Chris. I'm asking. Just asking for a friend. All right. Hey, my last setup here, or my second setup, is going to be Ethereum. And now, what's interesting about Ethereum is it is setting up a wedge, and I don't know where. There it is. There Ethereum is at. It's setting up a wedge, but I think if you're a crypto trader and you own crypto and you own, Bitcoin or XRP or whatever you're trading, you're probably and if you have some Ethereum, you're probably wondering why this hasn't moved higher. And I don't want to say you kind of got to give up on Ethereum, but if you get much below that 200 DMA, that means you're below the 618 retracement. That means there's probably going to be some selling back to 2400. Now, I think a good move above wedge resistance, which is about 3300 or so, that's going to produce some upside. I don't want to be short any cryptos, because if you're looking at Bitcoin looks like a very bullish consolidation. Actually, most cryptos do. I don't know what's up with Ethereum, and I don't follow Ethereum close enough, but I look at it on a daily basis, and what I'm seeing is it's just not performing as well as the rest. So if it's not, and you start to see some selling in crypto, then you got to be a little careful. Below the 200 DMA, I think opens up some downside, but flip side is maybe it could play a little catch up with some of the other cryptos out there and make a move above 3,300. Anyway, it is a setup. It's a wedge, and I think it's tightening up, ready for a move.
I like Bitcoin as well, but I think right now it's a two-way traders market. You've got to get rid of your bias. If you're trading Bitcoin, you can't be like structurally bullish. You just got to take, it's trading in a really nice range at the moment. People are very happy to buy it, below 99,000 and get up to sort of 105, 106. Then you're fading it, to be honest. But for me as a trader, you've got to get rid of that ingrained structural bias that the hodlers have, and just be a slave to where the market wants to go. It's a really nice consolidation, trend at the moment at those highs. So I just think it's a good two-way traders market, and that range needs to break out. But right now, I think given where sentiment is at the moment, it's probably missing a bit of a catalyst. A lot of really good news and very positive factors that have been in play and are in the price. I just think you've got a really nice channel range that needs to be respected and probably will do for a short period of time, and I think that's a really clear play two-way. Anyway, I'm going to keep it within the crypto spectrum. Let's go to play of the day. I take your wedge, and I'm going to have a look at a slightly different wedge in Ripple. Let's bring up the Ripple chart, XRP. So what I like about this one, Blake, yours is a really strong sort of consolidation where the market's been making a series of lower highs for a period of time and finding that support level. But what I like about Ripple is that you had obviously that huge move going into sort of December through going into December. Then we had the consolidation. We broke through the consolidation highs. We had a really nice impulsive move higher. And what I like about this is we've just been making that series of lower highs playing through. But like what you saw there's really, really nice horizontal support coming through. We've seen 2 days where we saw a really big down move. But look at the wicks on them. Huge support coming through there. So that's your risk. What I like about this is I wouldn't be trading now, because what we've seen is that we're just seeing, after a really strong impulsive move up, just that compression in volatility, those compressions in ranges. Think of it like a cold spring. That cold spring is getting lower. The bulls just haven't had that impetus to really push this one higher. So I think what we want to do is given there's so much structural support, the buyers are really pulling that one up, but we want to wait for the market to reveal itself, to show its hand, and when we get a firm close above that downtrend, if it does happen, but when we see and obviously if we would see that a really good range expansion on the break and the price close close to its highs, that would give me even more belief, because I love this setup. Things don't move up in a linear fashion forever. Had a nice breakout. We're just seeing compression. Let the bulls reveal their hand, that they're owning this again, and I think that when it does happen is the case to get long for a move higher again.
All right, Chris. Well, I tell you, that is impulsive. And a nice consolidation after an impulsive move. It looks like it wants to set up a third drive higher, which, after the third drive is usually, terminal. But right now, it looks like it still wants to build that third drive. I like it. I still think it looks bullish. All right. My play of the day is going to be for the weekend. And this is something I've been talking about inside our community. And that's something I wanted to make sure I shared it here on the trade-off. And this is the dollar CAD. Now, I'm looking at this as a broadening, it's a megaphone pattern. Now, megaphone patterns typically will break. In this case, they're more reversal patterns, so they come out the same way they came in. That means it should go down below the 50 DMA. Well, this is all predicated on what happens over the weekend. If Saturday comes and goes, there's no tariffs. The Canadian could possibly rally a little bit, but it's gonna find some support near 140. Now, that's what I hope happens. I hope that there's no major announcement over the weekend. Dollar CAD starts to fall, because I'm going to be down there buying it as we get close to 141 to 140. Because if tariffs aren't coming on the first, they're still coming. It's just a matter of when, not if, it's when. So I want to be down there buying it. Now, the flip side is, if some heavy tariffs are imposed on Canada, we're probably going to gap up above that long-term 161% extension. We start moving above 145.30. That's the top of the megaphone pattern. Then we get a move that really is going to be explosive to the upside, and I'll have to chase it higher, probably closer to 150 as it's making its move up. But I am playing it on the long side, either a dip, which I hope, but what I hope happens and what actually happens could be two totally different things. But that's going to be my play of the day, but it's going to be a play of Sunday night. Play of the day for Sunday night.
Mate, I hope to get the moon on the stick. I'm never going to get it, so it's just a question of... but it's nice to have, isn't it, at the end of the day? Anyway, it's great to be back, Blake. Great to be back with you and talking markets, thinking about the risks, thinking about trying to make some sense. Good for my head, good for the way of thinking, and good, hopefully, for you guys out there. We really appreciate you sticking around. We hope you had a really good start to 2025. We hope there's going to be a really, really good, prosperous year for everyone in the financial markets. Obviously, I hope you stay really healthy and safe as well. Reach out for any comments about how you're trading the start of the year, how you think tariffs are going to go down, what sort of asset classes we've missed, and what views you've had. We love all that. We'll catch you next week for more of the trade-off.